By now, nearly everyone remembers Subway's famous $5 footlong promotion. When it launched, it seemed to quickly take over. The jingle, the ads, the deal itself, it was everywhere. But behind what felt like an incredible win for customers was actually a ticking time bomb for one of the largest restaurant chains in the world. Because what followed wasn't just a slump in sales, it was one of the most drawn-out declines in modern restaurant history. The promotion ended up exposing a fatal flaw in how Subway did business. So this is the story of how the $5 footlong became one of the worst decisions in business history. It started as a simple idea in a single Miami, Florida Subway location. In 2003, franchisee Stuart Frankel was trying to drive foot traffic at his store. So he began offering footlong subs for just $5. At the time, this was only about $1 less than the normal price. At first, this deal was only during weekends, and it didn't require any coupons or fine print. But the deal caught on fast with local customers. Within the first 2 weeks, Frankel saw his sales jump from $14,000 to $23,000 per week. This was more than 4 times what the average Subway shop brought in at the time. The promo was working well, and it allowed for Frankel to expand his store count and offer the promotion at other locations. He tried to show Subway corporate the positive impact it was having on revenue and sales, but at first, nobody there listened. Fast forward to 2008, and the success was finally too big to ignore for corporate. By now, the promotion was being offered by other franchisees, but it was still a long way from a national rollout. Frankel was invited to a board meeting with other Subway franchisees that were deciding on what to do with the company's advertising budget for the year. He said the company was skeptical that the $5 footlong could make money. And to be frank, they thought I was a fucking idiot. Nonetheless, corporate agreed to test the promotion just a few months before the US fell into the great financial crisis, one of the worst recessions in US history. The timing was perfect. The country was in the middle of a recession, gas was spiking, job losses were climbing, and people were cutting back on everything. But a $5 meal that felt substantial was exactly the kind of thing Americans were looking for. The campaign exploded. Subway flooded TV, radio, and billboards with the now iconic jingle. And at first, the results were immediate. Within a year, the Subway $5 footlong did $3.8 billion in sales. That was more revenue than entire other fast food chains made all year, like Arby's and Domino's. It was the kind of promotion most marketers dream of, at least on the surface. But underneath the catchy hook and spike in sales, Subway had just created a problem it couldn't take back. Because this success was deceptive. Sales surged, yes, but profits didn't. Subway's business model was unique in the fast food world. It relied heavily on franchise fees and percentage-based royalties. Now that part in and of itself wasn't unique. A lot of franchises operate like this. But what was unique was how much Subway corporate took from the franchisee. 12.5% of gross sales every week, which coincidentally is one of the highest royalty rates in all of the restaurant industry. So while the $5 footlong may have been great for customers and Subway's corporate branding, for franchisees, it was actually a nightmare because they were left scrambling to make margins on a price that barely covered costs. For a more expensive sandwich, this was terrible for the franchisee. For a cheaper one, it might have made more sense, but this promotion ran for all subs, at least at the time. And that meant even if a franchisee was barely breaking even, or in some cases straight up losing money, corporate still profited. And the $5 footlong only made things worse because it locked in this ultra low price point while food and labor costs were rising over the years. What started as a limited time promotion turned into something that became Subway's identity. And the uptick in sales made corporate want to continue this deal year after year. In many cases, franchisees were earning just 30 to 50 cents per sandwich if they made any profit at all. Remember, this would heavily vary depending on location. But worse was the fact that as this became more popular and the limited time deal became cemented in customers' expectations, Subway corporate aggressively tried to push the promotion for years well beyond the original recession context and expected every location to honor it. When some of the franchisees tried to opt out by filing complaints with the Federal Trade Commission, some of them reported, quote, being bullied into honoring the promotion that they say doesn't make much money. So franchisees became stuck because it became impossible to raise prices without experiencing backlash. They couldn't afford to run the deal, but they also couldn't afford not to. And that tension between corporate branding and franchise survival would become the foundation of Subway's long-term decline. According to a 2018 article from Business Insider, the national promotion focus over the past 5 years had decimated and left many franchisees unprofitable and even insolvent. Now, I don't think the $5 footlong broke a great business. It exposed a bad one, which in all fairness wasn't solely about the $5 footlong. It was also about Subway's entire system, which was built around hyper-growth, not profitability, not quality, and definitely not long-term sustainability. While most fast food brands limit store density to protect franchisees from cannibalizing each other, Subway did the opposite. There were really no meaningful territorial protections. If you opened a Subway and it did well, corporate might approve another one 2 blocks away. Remember how I said Subway had some of the highest franchise fees in the industry? Well, that was offset by the fact that they had the lowest barrier to entry when it came to other national fast food chains. Now, I'm excluding Chick-fil-A when I say this because, while technically the upfront capital to open a Chick-fil-A is lower than Subway at only 10 grand, statistically speaking, you have a better chance of getting into Harvard than you do being selected to operate a Chick-fil-A. But anyways, the cost to open a Subway during this time frame was anywhere between $140,000 to $340,000. And at Subway's peak around 2015, they had over 27,000 locations in the US alone, more than McDonald's and Starbucks combined. By comparison, McDonald's had around 14,000 US locations that year, but with far higher revenue per store. In fact, McDonald's average revenue was over $2.5 million per store. Subway's was around 425 grand. That disparity revealed the real problem. Subway wasn't winning because its stores were successful. It was winning because it had more of them. As corporate revenue was tied to selling new franchises and collecting royalties, not necessarily to the success or survival of the people running those stores. And this set up a perverse incentive. Subway corporate profited from the expansion regardless of outcomes. Now, of course, this is very short-term thinking. But meanwhile, franchisees, many of whom were first-time business owners, were left battling each other in oversaturated markets, often with razor-thin margins. And when the $5 footlong came along, it just poured gasoline on that fire. But another problem was franchisees weren't just competing with the other Subway down the street. They were also being forced to honor this national promotion that ate away at what little margin they had left. And worse was they had no real power to say no. And this is just sort of some of the risk you can potentially run when you open a franchise store under a larger corporation's umbrella. Now, by the mid-2010s, the cracks were impossible to ignore. Subway's once unstoppable expansion began to reverse, and then came a wave of scandals and bad press. In 2013, an Australian teen posted a photo on Facebook of a Subway footlong that was measured and it came out to only 11 inches. The post went viral and a class action lawsuit followed against the company. Then Subway's longtime spokesperson, Jared Fogle, was convicted of some terrible crimes in a highly publicized case in 2015, which ended up damaging the brand's image. A year later, a Canadian investigation found that Subway's chicken only contained about 50% actual chicken DNA, which ignited controversy, even though the company denied the results. But in 2017, the class action lawsuit regarding the undersized sandwiches ended up getting thrown out, with the judge saying Subway customers know it's a matter of common sense that the baked roll won't come out to exactly 12 inches. Between 2015 and 2023, Subway had closed over 6,000 US locations, wiping out nearly a quarter of its footprint. Now, some of that was due to broader fast food shifts, but much of it came down to franchisees walking away from unprofitable stores. Many were locked into leases, struggling to hit break even, and unable to raise prices thanks to years of conditioning customers to expect the low price point sub. At the same time, competitors were pulling ahead. Brands like Chipotle, Jersey Mike's, and Firehouse Subs were positioning themselves as higher quality or more transparent. Subway, still known for quantity over quality, had no clear identity. And by 2023, Subway was struggling to keep pace. The company was quietly shopping itself for a sale and eventually struck a deal to be acquired by Rourke Capital, the same private equity firm behind Arby's, Dunkin', and Jimmy John's. It was a fitting end. A brand built on overexpansion and razor-thin margins was now being sold off to a firm for aggressive consolidation and cost-cutting.
Global sales for Subway peaked back in 2012 at $18 billion here. So you could see where a private equity firm would want to come in, make some changes, try to maximize profit, get it back to at least some semblance of that prior peak. So
between 2022 and 2024, Subway had closed more than 1,600 stores, with still having nearly 37,000 locations worldwide today. But what I find funny is even after all of the damage years later, Subway still couldn't fully walk away from the $5 footlong idea. Because in early 2025, the company launched a new promotion, any footlong for $6.99, available only through online orders using the code 699FL. It was a clear attempt to recreate the appeal of the original deal, with just enough of a price bump to try to reflect rising costs. But the promo didn't land the way they hoped. Some franchisees reported little to no uptick in traffic, and of course, many said the deal wasn't profitable, especially on higher cost sandwiches. I don't think the real problem was the $6.99 price point. It was that customers had been trained to expect less. For years, the $5 footlong set an artificial benchmark that no longer made sense in a world of inflation, supply chain costs, and higher wages. But once that number was burned into public memory, anything higher felt like a ripoff. Price is always relative to the perceived value, and it would appear to many customers they don't feel like the quality of the food is there at Subway, at least not for the current price. This is the lingering cost of the $5 footlong, a price-driven brand identity that can't scale with reality. Every new promotion is judged against a decade-old marketing gimmick. And no matter how much Subway changes the menu, remodels its stores, or tries to refresh its image, it still can't shake the perception that its sandwiches should be better and somehow still cost $5. Now, if you want to understand how these insane fast food price hikes actually help prop up a declining sit-down chain, well, you should check out my video here on why fast food's greed ended up saving Chili's. Thanks for watching.